Alright guys, welcome back. Today we're going to discuss debits and credits. Debit is abbreviated by DR, credit is abbreviated by CR. As far as the definitions for debits and credits go, debit simply means left, credit simply means right, and that is really all the definition that there is out there for them. They don't mean increase, they don't mean decrease. In fact, what you'll find is that debit can mean both increase and decrease. Credit can mean both increase and decrease, depending on the type of account we're talking about. We do have to look at our expanded accounting equation when we are looking at debits and credits. If we wanted to use the finger trick method, which is a video that I did post out there for you guys to look at. The expanded accounting equation, if you will remember, is assets equal liabilities plus owner's equity plus revenues minus expenses. Now we do have normal balances that we are looking for. So with debits and credits, all of our accounts will have a normal balance. The normal balance is how we increase an account. So when we look at things, remember debits are on the left, credits are on the right. So if you want to use the finger trick video, what you'll do is you'll take your left hand and you will make a Y. So that's your pinkies up, thumbs up, all the other fingers are down. On the credit side, which is your right or your right hand, you will hold up your the 3 or what looks like a W. So you would have those fingers up and your pinky and your thumb would actually be down. Now this is important because what we are looking at here is that if your fingers are up, that will be an increase on that side. If your fingers are down, that is a decrease on that side. And your fingers do correspond with that expanded accounting equation. So what we will see is that for the debit side, the assets and your expenses, those fingers are up, so those would increase with a debit on that left side. Your liability, your capital account, and your revenue account will decrease. Those fingers are down on that left side. When we look at our right hand, you notice we have 3 fingers up. Those fingers correspond to liabilities, to the credit, as well as to your revenue. So those fingers are up. That means that liabilities, capital, and revenue are going to increase on that right side with that right hand. Your assets and your expenses are going to decrease on that right side. So this is one way of trying to remember what increases and what decreases by using this finger trick of Y3. In looking at it, what you will see is that as far as your accounts go in your normal balances, which again is how we increase them, assets and expenses will have a normal balance on the left side as a debit. Liabilities, capital, and revenue will have a normal balance on the right side as a credit. The only account that is not looked at with this finger trick is going to be that drawing account. And that drawing account does have a normal balance that is a debit. It is opposite of that capital account. Remember, capital is an increase in our owner's equity and drawing is a decrease in our owner's equity. So that is why they are different. And those things that you will see there. For debits, you notice here that we do have a word. We have aid. So think of it, lemonade, Powerade, Gatorade, however you want to think about it. Those are the normal balances on that particular side. As far as the credit sides go, if you look at the capital and the revenue, they actually spell out that abbreviation. So that is that credit. So those are some other ways to just remember which side we will increase the accounts on. So next time, hopefully, if I can get my videos to work right, we'll go in and we'll actually look at a worksheet on what is has a normal debit balance and what has a normal credit balance.